All right, welcome to The Explainer. Today, we are diving into a huge story that's sending shockwaves through the markets. We hear constantly about this unstoppable AI boom, right? But what if the first major crack just appeared? Let's get into it. So, this is the question on everyone's mind. Is this incredible AI frenzy a real sustainable growth story? Or are we all just living inside a massive bubble that's getting ready to pop? It is quite literally the multi-trillion-dollar question. And a new development has just sent a jolt of real fear through the whole system. Yep, you heard that right. One of the biggest companies betting its entire future on AI just got some really bad news from its creditors. And now a lot of people are wondering, is this it? Is this the first domino to fall in a huge sector-wide collapse? The company right in the middle of all this is Oracle. Now, they've gone all in on building out the massive infrastructure that AI demands. But the big question is, did they bet way too much, way too fast? We need to take a closer look at what's really going on here. Okay, so here's the deal. Analysts at Barclays took a hard look at Oracle's books, and they saw a big problem on the horizon. See, the company has taken on an enormous amount of debt to fund all these AI projects, but the cash flow they're projecting, well, it's not going to be enough to cover their debt payments come late 2026. And that puts them dangerously close to being labeled junk bond status, which is a massive red flag for any investor. But this is where the story takes a really interesting turn. Is this an AI problem, or is this an Oracle problem? I mean, just look at this comparison. Oracle's debt-to-equity ratio is a staggering 500%. Now, compare that to other AI giants like Microsoft sitting around 35% or Amazon at 50%. This is not a sector-wide issue. This is a very specific, very high-risk situation happening inside one company. So, if Oracle isn't the first domino, then what is the real story here? Well, we don't think this is a bubble. It's something much, much bigger. What we're seeing is a massive, high-stakes build-out of an entirely new technological foundation for our economy. But that doesn't mean there isn't risk. Oh no, the market is terrified, but for a completely different reason. And to understand that risk, we need to talk about something called a credit default swap, or a CDS. Just think of it like an insurance policy. If you lend a company money, you can buy a CDS to protect your investment in case they go under and can't pay you back. The cost of that insurance, the premium, tells you exactly how risky the market thinks that company is. And this brings us to the real puzzle. If AI isn't a bubble, if this is a healthy long-term build-out, then why are those insurance premiums on AI companies getting so expensive? Why is the market's fear gauge cranked all the way up to 11? Get this. The cost to insure against debt from AI-related companies is now way higher than the cost to insure against bank debt. That's wild. But here's the key. This isn't fear of a collapse. It's a fear that comes from the mind-boggling scale of the investment that's needed. Companies are borrowing historic amounts of money for projects that won't see a big payday for years. And that long, uncertain timeline, that is the risk. To really get a handle on that risk, you have to understand the true scale of this thing. The numbers we're about to look at are not business as usual. This is more like nation building. Let's just start with the basics. $5 trillion. That's with a T. That's just the estimated cost for the core infrastructure. The data centers, servers, the superpower chips, just to get this revolution off the ground. And all that hardware, it needs a ton of juice. It's estimated that the US alone will need to build the equivalent of 50 new nuclear power plants. Not one, not two, 50, just to meet the energy demands of AI. So you add it all up, and you land at $5.5 trillion. And that's the minimum upfront investment we're talking about. Look, private companies can't foot this bill alone. This is a historic demand for capital that's going to require government-level support. And this chart really puts that into perspective. Using a standard economic multiplier, that $5.5 trillion investment could have a total economic impact of over $20 trillion. To put that in perspective, that is roughly 2/3 of the entire US GDP for a whole year. We are literally rebuilding a huge piece of our economic engine from the ground up. But look, a transformation of this size doesn't just happen on a spreadsheet. It has a real, tangible human cost. When you rebuild the engine of the economy, some old parts get left behind. We have to talk about the labor shockwave that's coming. And this isn't some abstract problem for the distant future. The people at the highest risk of being displaced are Gen Z and millennials. And why them? Because together they make up the single largest chunk of the workforce right now. A massive wave of unemployment for these generations isn't just some fringe possibility, it's a probability that, frankly, we're not preparing for. These kinds of huge foundational shifts in capital, they create really strange effects across all markets. And to see another example of this exact thing happening right now, it helps to look at a parallel story, what I'm calling the Bitcoin paradox. So here's the mystery. The big Wall Street institutions are pouring billions and billions of dollars into these new Bitcoin ETFs. Now, basic market logic says all that new demand should be sending the price straight to the moon. But it's not. The price has been kind of stuck. So what gives? It's because there's an equal and opposite force pulling in the other direction. While all this new institutional money is flooding in one door, the early Bitcoin pioneers, the people who got in years and years ago, are now selling. And they are selling in absolutely massive volumes. They are cashing out. So what's happening here is that this huge wave of selling from the early adopters is basically acting like a giant IPO. It's creating so much new supply that it's completely absorbing all the new demand from the ETFs. It's a temporary balance, a massive tug of war between the old guard and the new money. Okay, so let's pull all these different threads together. After digging through all these market signals, what have we actually uncovered? What's the bottom line? Well, first, that Oracle downgrade, it's not the first domino in an AI collapse. It's a warning about the dangers of taking on too much debt in this incredibly expensive race. Second, this AI boom is not a speculative bubble. It's a real, tangible, multi-trillion-dollar build-out of the world's next great infrastructure. And finally, the economic and social fallout from this shift is going to be immense, especially for the people working today. So no, we are not floating in a bubble. We are standing on the ground floor of a massive, high-stakes economic reconstruction. The technology is real, the investment is real, and the disruption is going to be very, very real. And that leaves us with the most important question of all. Are we, as a society, even remotely prepared for what comes next?